Everyone, thanks for joining. We're just going to get going in about a minute or so, just waiting for the last few people to join in, and we'll get rolling. Thank you. All right, folks, let's get going. Warm welcome to everybody for joining us today. Thank you so much for being here. We've done a few of these webinars before, and we wanted to continue them. Part of our objective is to add as much value as we can to our clients, not just for financing, but in other areas as well. I'm super excited today to welcome Brendan and Frankie from Platform Insurance. And we're gonna have a really good webinar today on bonding. So a couple of housekeeping items I'll mention is number one, if you have questions, put them in the chat as soon as they come up. We may take questions if they're pertinent as we go along, but for sure we've built in a lot of time for Q&A, so we'd really love to answer any questions that people have. So please make it as interactive as you can. Put the questions in the chat as soon as you think of anything, and we're more than happy to take them. With that, I'm going to share my screen. We're going to get into our presentation and kick it off. So as I mentioned, we're covering bonding and insurance for development 101. It's a bit of a primer for developers and capital partners, right from acquisition through completion. We'll cover this is what we'll cover today. We're going to introduce ourselves and Platform Insurance. We'll talk about CMHC bonding, the requirements, and how bonds work. And then, Platform will take us through their underwriting and deal structures, rates, fees. And then I'm also excited not just to cover bonding, but also there's development or LC replacement bonds, as well as construction lien bonds, course of construction, and lots of time for questions. So that's what we'll cover today, but we'll spend most of our time on bonding, especially with regards to CMHC's requirements for it. So Brandon and Frankie, over to you guys to introduce yourselves.
No, appreciate that, Nadeem, and thanks everybody for joining us today. So Platform, we are a national privately owned insurance brokerage specializing in surety and insurance in the built environment. So we have about 200 employees across Canada, and our focus is primarily we're laser focused on construction and real estate. Frankie and I specifically run our developer solutions group, and we're Canada's only national vertically integrated brokerage team built exclusively for developers. We played a leading role in advancing bonding acceptance across Canada. We've built bonding solutions for CMHC, which we're going to touch on primarily today. We've built and we've also placed billions in deposit insurance for developers nationwide. That's our focus.
Good to meet you. Fantastic. Thank you. Yeah, quick background on ourselves. We're a leading independent commercial mortgage brokerage. We cover the whole country as well. We've got over 50 years of combined experience, over $8 billion in funded volume as a team. And we specialize in term construction, bridge, owner user mortgages, as well as institutional equity and grant facilitation as well. So cover every commercial asset class from multifamily commercial hospitality. And our goal is to simplify the lending process with expertise, speed, and precision. And part of that is webinar today with really talented and experienced guests like we have. So really looking forward to continuing to add value. And here's, as I mentioned, term, permanent, bridge, institutional equity, construction development, which is where most of the financing that bonding applies to will come in, as well as some of the other areas we talked about. So without further ado, let's talk about bonding in terms of protecting construction financing. And so one of the things that I want to talk about is really the reason that lenders require bonding. So essentially, lenders and CMHC see it as a risk management tool, a risk mitigant tool that protects not just the lender and CMHC, but also the owner as well. And I know Brendan and Frankie will speak to that. So essentially, it's a guarantee from a third party surety company that the construction project will be completed, key subcontractors will be paid even if the contractor encounters financial performance issues. So it's kind of that mitigant or that fallback if there's issues with the development. And so, some of the biggest risks that, CMHC and lenders looking to mitigate here is contractor bankruptcy. A really important one is failure to complete construction. And Brandon and Frankie will talk you through sort of what happens in some of those cases. Major cost overruns are a really big risk. Construction liens from unpaid trades can really put a halt on financing. From our standpoint, when there's liens in a project, loan advances cannot continue. So it's a really important piece. And then, project delays and timing. If you've been in the construction industry long enough, you know that projects can get delayed, and sometimes it happens more often than we'd like. So essentially, bonding helps mitigate those risks by transferring a portion of the construction risk to a financially strong surety company that can help step in the event that any of these types of issues are faced. And one other thing I'll add too is, the focus of this is around CMHC and CMHC's bonding requirement. But I'll mention as well that from my experience placing construction financing, I sometimes see lenders look to bonding, even in non-CMHC construction loans, as a risk mitigant, especially when they feel there's a little bit more risk on the deal than they would prefer. So sometimes it's a tool that we've used to help get an approval or help maximize leverage or optimize financing in non-CMHC cases as well, when deals are kind of on the margin, I would say. So I want to just make sure we're keeping that in mind as well. Our focus will be CMHC, but it can come into play in non-CMHC cases as well. So, CMHC specifically, it's one of the preconditions to authorizing advances, generally required. And this is one of the changes that's happened with CMHC construction financing over the last year or so, is that they're generally requiring bonding much more often, especially for projects that are 25 units or greater, to help minimize the risk. So essentially, we'll get into what they require, but then generally they're going to require bonding or one of three alternatives to bonding. So I'll touch on that. And as I mentioned earlier, it's becoming more relevant as well for CMHC insured, for non-CMHC insured financing, excuse me. A couple of quick things I'll touch on. This is sort of like the formal definition from CMHC, but for projects of up to 24 units, CMHC's position is bonding or an alternative may not be required, but CMHC still has the discretion to apply it or not. From our experience, generally projects under 24 units, we've found CMHC hasn't required bonding or an alternative to it for construction financing. So that's a good thing. However, projects 25 units or more, especially in the last year or so, we're finding that bonding or an alternative is generally required. CMHC's indicated at their discretion they may waive bonding or accept an appropriate alternative, which I'll touch on briefly, where the recommendation is made by the lender after assessment of the risks. So I'll just quickly touch on the three alternatives to bonding, just to set the stage for why bonding is really important for us to look at. But the three big alternatives are: number one, an irrevocable and unconditional letter of credit in an amount of no less than 10% of the project's hard costs. So this letter of credit can only be released once substantial completion of the project is done and confirmation all subtrades have been paid. Number two, collateral security in an amount no less than 10% of the project's hard costs as well. Generally released again at substantial completion. I found from my experience, CMHC is looking to take leverage to a maximum of 75%, ideally in first position, but we've had some that they've agreed to put in second position, again, as an alternative to bonding. So also not necessarily ideal, but you should be aware of that. And then the third alternative, which is probably I would say the most punitive, is simply a reduction in the construction loan. In this case, it's actually 10% below the maximum loan amount. So, these can be quite challenging and in some ways punitive to borrowers. And we'll get into what bonding looks like if one of these alternatives aren't available or are more challenging for a borrower to get into. So over to you, Brendan and Frankie.
No, I appreciate that, Nadeem, and I think we completely agree with what you're saying there too. And we're seeing, it seems like 9 out of 10 loans over 25 units and above are getting hit with some form of bonding requirement. Frankie and I are seeing them weekly now, and we're seeing conventional or very bespoke ways to kind of handle the requirement that CMHC is imposing. I mean, some of the other products that Frankie and I help with are CMHC required bonds, which we're going to talk about today, obviously. subdivision and development bonds we'll touch on later. Deposit insurance and carry-on bonds was kind of the foundation of our practice group. And as we grew and the market kind of shifted towards rental from condominium, so did our team and figuring out how to help developers on this newer bonding requirement. And we also help developers with developer project protection insurance, which is basically a developer-held subcontractor default insurance product. We'd love to talk to groups about more. Construction lien bonds, which we'll speak to later, bespoke bonding solutions. And then our group also focuses on project insurance and operational P&C. So your construction insurance throughout the build, as well as insuring the asset post-construction.
Go to the next slide. Okay, so what we're all here for is CMHC bonding. So we're going to discuss what are the bonding requirements from CMHC, how these performance and labor material payment bonds actually function, the benefits of bonding, our underwriting approach to getting bonding procured. We'll discuss how we evaluate projects, and then we'll talk about rates and deal structures. Mm-hmm. Okay, so CMHC's bonding requirements. So Nadeem mentioned that there all are alternatives to bonding. So those are an LC for 10% of hard costs, a collateral mortgage on an unencumbered piece of land, or a reduction in the loan amount, which is essentially more equity. So most people go with bonding. So on your certificate of insurance, you're going to see either option A or option B. Option A is the full fixed price contract being bonded. So this is traditionally when you enter into a CCDC 5B or a CCDC 2 contract. That could mean that you're using a true third-party general contractor, or perhaps you have a vertically integrated GC arm within your development firm. We would bond that on-risk contract for 100% of hard costs. So in that event, we would issue a 50% performance and a 50% labor material payment bond on 100% of hard costs. Option B is your major contracts bonding. This is when you're going to be relying on a third-party construction manager to oversee construction, but you are going to be holding the contracts. So this is an off-risk contract. So you're just relying on a CM to oversee construction. It could be under a CCDC 5A or a construction management agreement. In this case, we often see CMHC require the performance and L&M bonds from the actual subcontractors. These are your critical path trades. So usually that equates to a minimum of 2/3 of your hard costs. So in this case, you would be going to your critical path trades and asking them for bonds. Mm-hmm. So in a normal case, you might have 6 to 8 different contractors on a project providing you with those bonds. These bonds are dual obligee, meaning both the owner and the lender have direct access to claim on these bonds.
So then this is a really important point too. Like a couple of things here I want to quickly touch on, if I may. Like one is, like sometimes I have borrowers come to me and throw their hands up and go like, CMHC's putting more obstacles in front of us. Like, what is the point of getting this bonding? It's just another cost to my budget. But it sounds like what you're saying, Frankie, is that there's actually benefit to the borrower, to the owner as well, not just the lender, which I think is really important to underscore.
Yeah, of course. If there is non-performance on a contract or a sub does fail, the owner can claim on that performance or L&M bond, and the surety will come in and act. So they'll either replace that contractor, they could pay out, they can finance that contractor if they went insolvent. They have lots of options. But yes, it's definitely a benefit to not only the lender, but also the owner.
And the other thing I'll say too, and I know we'll maybe touch on this later, but the full fixed price contract versus major contracts, that's one of the things that we talk to clients about early, is deciding which path they'll go. Are they going to get a GC to do the whole thing? Are they going to, many clients self-perform and they'll do the whole thing as well, and others will have sub trades do it, and they need to have 2/3 of the hard cost fixed. So I think one of the things that I would recommend is like getting in touch with groups like Frankie and Brennan platform early, even as you're deciding which path to go on, because there may be some considerations with bonding. Is that fair?
Yeah, definitely. I mean, part of it is we'll help you evaluate your subcontractors bonding, the pricing that they provide for, because everybody has their own facility and capacity that they're going to be providing you from a sub level. And then we can also go out and work towards getting you the option of bonding fixed price contract in totality, so you can kind of compare apples to apples.
Yeah, and Brennan's going to talk about this more in future slides, but sometimes one or two or maybe all of the subcontractors might not have access to bonding, or they can't get approved for bonding. So you might have to switch to a full fixed price contract early on. So it's helpful to know that.
Yeah.
I mean, Nadeem, I guess I kick it to you. I guess with that regards too, you're having these discussions with your groups early on, and you're deciding if we're putting forward a construction manager or if we're going to put forward as general contracting when you're going to CMHC specifically, and that's generally when it's good to get us involved as well, and typically with the quantity surveyor, so we can have these discussions early on and nail down, plausibility of doing it and getting these bonds from either yourself or the subs, as well as what that pricing looks like.
Yeah, 100%. I think that's key is deciding it early. And one of the things I want to people to leave with is this decision isn't just, what matters for financing or what you want for your project, but the viability of bonding and how that plays in. So it's just another decision criteria. So that's great. Appreciate it.
How these bonds function. So, I mean, we get a lot of questions here on this. I think developers have used bonds for years, but I don't think they've typically used performance or L&M bonds or had it required. So the performance bond, I mean, and I know Nadeem, you highlighted this earlier on, it's really to fulfill and complete the contractual obligations of either the sub or the general contractor in the event that they don't perform their work or default on their contractual obligations. So that's the performance bond, and the L&M bond is there to guarantee that claimants, being subcontractors and suppliers, are paid for their work on their project. So that's labor and material, ensure that everybody is paid who came on site. So under a CCDC standard form, a claimant is any party with a direct contract with the principal for labor, materials, or equipment rental. And I know we say typically it's issued for 50-50. Outside of CMHC, there's been requirements for lesser than 50 amount or 50%. But CMHC is typically going to be 50-50 on a 50% performance bond and a 50% labor material bond on, again, whatever contract it's tied to.
So does that mean essentially that the bond will cover 50% of the amount of the contract in the event of a claim, essentially, or what does that mean?
We get asked this a lot. You're basically bonding 100% of your contract with two different bonds, each valued at 50% of that contract.
So let's just say it's a $10 million contract. You have a 50% performance bond. You're gonna have a $5 million performance bond. For the most part, you're not gonna have a full contract dissolve completely. Contractors usually fail at some point during construction. So usually it's industry practice to say, hey, if you have 50% of that contract bonded, we're good, right? Rarely do you see a full penal sum claim on a bond. So that's why it's standard industry practice to have those 50-50 bonds.
Got it. Makes total sense. Thank you.
Yeah, I mean, the benefits of these, it is risk transfer. You have a very well-capitalized insurance company that can step in to complete the project or compensate for any losses. I mean, really, you're shifting risk off of yourself as owner, and it does provide that lender some additional protection. I know we spoke on this on the last slide, but it's a completion guarantee in the event that there's non-performance, and it also ensures that subs and suppliers are paid. Which does prevent disputes and inherently liens that can impact projects, especially when you're trying to keep funds flowing. The other piece is these sureties do a very strong vetting and pre-qualification where they are doing a financial analysis and underwrite. They're looking at subs or general contractors, accounts receivables, accounts payables, their backlog, their experience, and they do provide just another level of vetting of the groups that you're going to be working with. So there is that added benefit to going through the route of bonding. Is if generally a sub or a GC can't provide bonding, it's a surety's done an underwrite and it's seen something that maybe was a red flag. Now that's not always to say that it's not doable or you shouldn't use that sub, but it does give you just another level that there's an impartial or unbiased party who's evaluated these groups.
Sometimes they're just too small.
Yeah, that's fair.
Right? Sometimes they're just too small of a subcontractor to have, the financial strength to get approved for bonding. And it has nothing to do with their ability to actually complete the job. But it just is what it is sometimes.
Yeah. And a quick question here is are you typically seeing that you need to, if you're bonding subtrades, need to bond sort of that core group of, I think you said 6 to 8 subs? Is it typically this similar group, or do you find kind of project specific?
Yeah, it's the critical path subtrades. So it's usually 2/3 of hard costs. It's usually the largest contracts. CMHC's loan handbook clearly defines them. But at the end of the day, the QS, the risk consultant, they're all going to work together to decide what needs to be bonded. We don't decide that as a bonding company. The lender might have a say in it. There's a lot of stakeholders involved in that decision, but CMHC does outline what a critical path trade is. Performing contractors, mechanical, sometimes elevators. It's usually the larger contracts.
Yeah, makes sense.
Like for example, landscaping would be excluded from that, right?
Right. So no, not as much worries for the smaller trades. Got it. I'll see if I can pull that up before.
Yeah. Okay. So how do we approach?
Yeah, great. Thank you.
The underwriting. So bonding for the most part, is secured by a guarantee, right? So an indemnity agreement is signed by the beneficial owners of the general contractor or the vertically integrated construction company. So we have to leverage the financial strength of the guarantor. So we usually look at the balance sheet, the financial statements, and we try to come up with a working capital number that makes sense for bonding. Every insurance company, every surety company looks at financial statements differently. Some like certain things, some dislike certain things. So there's not a one-stop shop for every financial statement. They're all different, and surety companies like different things. And with that, we have to structure the right indemnity agreement. So perhaps just the general contractor entity doesn't have the financial strength to get the required bonds. That doesn't mean we can't take additional guarantees of related companies, or maybe the personal guarantee of the beneficial owners of the general contractor or the owner. So we got to get creative sometimes when it comes to the indemnity structure, and then we also got to coordinate with everyone, right? So like I said earlier, the risk advisor, the lender, the QS, and other parties are often involved in deciding what kind of bonding is required or is acceptable. So we're happy to work with the QSs, the risk advisors. They're all our friends. They've been doing this with us for many years. So we can structure bonding solutions with them. And then lastly, just tailor the project. So, everything's different. Everyone has their own unique story, their own unique way their companies are structured. But for the most part, we can always usually find a solution to get something bonded at the end of the day. So how do we evaluate a project? These are the things that we will ask for when we go to underwrite a project. So number one, there's the project and the developer specific items. So, the standard stuff like your budget, pro forma, the project schedule, the financing commitment letter. Sometimes we might ask for a list of your critical path sub trades. The certificate of insurance is definitely important because that outlines the type of bonding that is required. And then as well, we'll probably want to understand what the developer's track record and delivery experience is, even if they are relying on a true third-party GC. Like often if a third-party GC fails, at the end of the day, it's still the developer's responsibility to replace that GC or sub. So we will underwrite the developer themselves. And then we'll also look at the builder and the contractor, because at the end of the day, this is a performance bond tied to a CCDC contract. So we want a copy of the CCDC contract, whether that's a 5B, a CCDC 2, or it's just a CM agreement under a 5A. We'll want to review that. We'll usually ask for financials from the general contractor and any other potential guarantors, related companies, stuff like that. Want to understand the general contractor's work on hand. So what are their current commitments and backlog? Do they have enough men and women and crew to complete this job? Or are they do they have 10 projects on the go and we don't think they have the capacity for this project? We'll look at that. And then we'll also look at liquidity, receivables, and available security. And oftentimes, we will work with Nadeem and Greenbirch to get a lot of this information because they'll already have it when they go to CMHC and the lender. They might not have the GC info, so we'd get that separately. But for the most part, a good chunk of the information is readily available.
Yeah, and we'll work hand in hand with the mortgage broker to kind of get that information and kind of work on the milestones that we need to hit.
Yeah, I think that's a really good point. Is the collaboration, bringing all the parties together. The mortgage broker with the insurance company, make sure that we collaborate, because a lot of this information we already have, so efficiently can be shared. A quick question for you guys, but my sense is borrowers can get ahead of a fair bit of this early, even before applying to CMHC. What do you guys typically find is helpful in terms of timing?
Yeah, we totally agree. I think whenever a project's contemplated, like we usually sometimes get involved early days when they have to bond certain site works, right? Before they even go to get financing. So we'll have discussions with clients about, hey, like, how are you planning on financing this? Is it through CMHC? And if it is, hey, there's going to be a bonding requirement. Have you thought about that? And that gets people thinking about, okay, I need to be careful about the GC that I'm going to choose if I'm relying on a third-party general contractor. I need to make sure I vet my subs, right? Because the last thing you want to do is, have a bunch of subcontracts signed and they're not bondable, and then you see a COI and there's a bonding requirement, right? So early days, to your point, super important.
Well, I mean, and the other piece on the early days is a lot of the information may not be available. The CMHC COI sometimes comes after the fact. We've already approached the market because we're just trying to get ahead of it, get a sense of, hey, can we get bonding? And also, what does that pricing look like? But I think Frankie and I also want to understand the narrative that we're presenting to the sureties as early as we can, because we want to present you in the best foot forward, and getting us involved early and understanding the team and your experience and kind of everything is very important for us as well.
Yeah, for sure. Yeah, I think that's like really well put. It can't stress this enough. Is like it is like if you're not able to get bonding because you haven't planned appropriately ahead of time, then it could be a showstopper. So it's yeah, really good points. I totally agree.
Next slide. So the 3 ways to make a project bondable. These are the 3 that we generally run into. So number 1 is you're a developer who's vertically integrated. You're building it for yourself. What we've seen for the most part when it is somebody who is building for themselves, they have an in-house CM or GC, is CMHC requires that the major trades are bonded. The issue, again, that we've ran into time and time again is bonding is newer to the residential space, because a lot of these residential builders or sub-trades, especially in tertiary markets, haven't bid on municipal works where bonding is common. And as a result, we may run into issues where subs can't qualify for bonding. And again, maybe it's just because they're just not big enough for these specific projects. We can still structure bonding around the in-house GC or on the fixed price contract, call it. But this is one of those things where we always tie back to get us involved as early as you can and start talking to your subs as early as you can, just to get a sense of if they're bondable from the get-go when you're going through that bidding process. So that's the vertically integrated guys. Third-party GC is typically more straightforward. The GC is providing you the bonds as developer. The surety is underwriting them specifically. They're underwriting their financials, their wherewithal, their work on hand, their capacity, their experience. And the bonding will, for all intents and purposes, tie to that CCDC 5 or 2, and that's the contract that the performance and payment bonding is tied to specifically. Again, we can always work when there's issues on some bespoke solution, but it's a little bit more straightforward, I find, when you're using a third-party GC. And then third, which ties into what I was saying on 1, is the sub-trade bonding route, where you're getting your critical paths to provide you bonds directly from their surety providers. Again, we run into issues there a lot, normally on smaller projects. On bigger projects, a lot of these subs are well qualified to get bonds, but these are the 3 options that you'll typically see.
Yeah, and I'd say, like, if you're doing the true third-party GC and your general contractor, isn't playing ball and doesn't want to provide a bond, we can speak to them.
Mm-hmm.
A lot of general contractors, they have surety facilities already, and they might not want to touch them because it's capacity that's important for them. We can always look to structure stuff outside of that facility that they have. So it's worth a conversation with us with that GC. So we're happy to get introduced to your general contractor if you are going to rely on a true third party.
Or your subs.
Yeah,
Similar.
or your subs. Yeah, great point. Like, if the problem with the subcontract bonding is, if 2 or 3 of your subs can't get a bond, then you're kind of out of luck, right? Because CMHC's requirements are that 2/3 of those hard costs and those critical path trades are bonded. So if they have trouble getting a bond, introduce them to us. We're happy to work with them to see if we can get it done for them.
Is there any any guidance you can give in terms of which ones might be easier or tougher to get, or what contexts might mean that people should consider one over the other, or is it totally like case dependent?
It's totally case dependent, right? Like, if you're vertically integrated, like that doesn't always mean you have a true third party GC arm.
Mm-hmm.
If you do, it makes it really easy because it's a separate company, right? It usually has its own employees, and like we can
It's well capitalized.
We can bond a fixed price contract like that.
Mm-hmm.
we often run into issues where, if you're doing a third party GC structure, like these projects aren't always small, right? So let's just say it's a $50 million hard cost project. This third party has to provide 50 million bucks of bonds. It's not an easy task. So it can eat into their existing capacity, or they might just not want to do it, right? So it really depends, and that's why it makes sense to start thinking about bonding early, having those conversations with GCs, and like if you have a GC that doesn't want to provide a bond, we have lots of clients of ours that are bondable, and we're happy to make introductions to GCs as well. We can just be used as a resource to kind of help decide which of these three makes sense.
Yeah, that makes total sense. It comes back. I know it's not like a broken record, but like planning for this early. I'll also touch. I know we talked about this earlier. Like the CMHC Lender Handbook has specific guidance on what type of subtrades need to be bonded, and I'll just read out the exact wording from CMHC's policy, which is, as an alternative, the lender may accept 50% labor material bonding and 50% performance bonding on all major subtrade contracts, which must include structural, mechanical, electrical, forming, and concrete. So they've listed sort of those five. Anything you want to add there? Is that
I'd say we've seen other contracts. I mean, if it's just a large contract and maybe it's not a known sub to call it the quantity surveyor, or maybe even in the industry, or they're jumping in scale or scope to what they've typically done, they may also be asked to get bonded. I think it does come down to that discussion with the quantity surveyor as early as you can, because a lot of the time that recommendation is being made to the lender from
right.
the cost.
Yeah.
I think it's a great point. And a lot of these QSs and these risk consultants, like they know these subcontractors very well. So oftentimes you might have them recommend that a certain subcontractor provide bonding, or they might even say, hey, like we might recommend to the lender that this subcontractor's got so much experience, and like we've seen them do this a million times. Hey, maybe you don't need a bond from them. At the end of the day, it's the risk consultant and the QS that work alongside the lender to say, hey, you have the appropriate bonding in place, go ahead and fund. So every situation is different, I'd say.
Well, other than the fixed price where you're kind of stuck
when you're stuck, you got to bond that.
Yeah, makes total sense. Thank you.
Okay, so rates and fees. What does it cost for bonding? I'm sure it's pretty important for everyone on this call. So we usually like to benchmark a rate of 1.5% of your hard costs. This could be much lower, or it could be much higher. And it's also totally dependent on if you're using a fixed price contract or you're getting bonds from your subs. So if you're bonding a full CCDC 5 year or 2, which is 100% of your hard costs, I benchmark 1.5%, put that in your budget. We've seen them way sub 1%. We've seen them above 1.5%. But as a benchmark, we feel as if that's a safe percentage to put. So it would be the rate applied to your contract value. And we also think that the 1.5% on the hard cost value is a good benchmark if you're going to get bonds from your subtrades. And the reason we say that is because CMHC's requirements is 2/3. If you're going to get bonds from your subs, you're going to have 6 to 8 different bonds from 6 to 8 different insurance companies, from 6 to 8 different contractors that all have their own rates and risk profile. So it's not a straight line when it comes to rating and providing a structure of what the fees would be for that subcontractor. And some of them might even gross that up, right? Maybe they're paying 1% and they're going to charge you 1.5%, just the cost of doing business.
It's an opportunity cost.
Yeah. So 1.5% is a great benchmark rate. Apply it to your hard costs. Try to put it in your budget when you go and talk to Nadeem and team and go to CMHC. We can probably get it lower if it's the right risk, but it's a good benchmark. And this is built up front at the start of the project. So rate applied to contract value, and it's usually drawn from the lender's first advance.
Yeah, so a couple quick things here. One I'll say is like these costs can and should be included in our budget that we're using to apply to CMHC because they can be financeable. So that's the first thing I'll say, because it's a legitimate project cost based on a requirement that CMHC has. The second quick question I have for you guys is what drives that that cost going up or down? Is it experience? Is it project size? Is it like
Yeah,
combination?
I think it's a combination of everything, right? Like if you're dealing with a super well-heeled developer group, a super well-heeled GC group that has amazing financial statements, like you're going to see that rate way below 1.5%. If it's a super small project and they've never had bonding and their financials are kind of on the edge, you might see it above 1.5%. So it's really a mix of both. Experience, financial strength is probably the biggest of all of them. Project schedule is also a big one, right? Like if it's a 36-month build versus a 48-month build or a 12-month build, right? And again, every surety market has their own pricing and risk profiles when it comes to different things. So it really varies. But yeah.
Yeah, I mean, I agree. Like credit is the strongest. Is the first thing everybody's looking at is the financial wherewithal of the group, and then secondly, I agree. It's character, it's experience, it's have they done this before? Are they known in the industry? It's a holistic look of either that GC or sub.
Yeah, and I'd add, like, we have some surety companies that, like, they don't just look at the financial statements. Like some surety companies like owners that have income producing assets that they can pledge towards the guarantee, which can often bring the rates down. Like if they have a purpose-built rental project that's already built and they can pledge that guarantee to a surety company, it might get them a better rate. Everyone looks at it differently though. And there's in terms of like who the players in the space that do this, there's probably about 8 to 10 surety companies Canada-wide that can do these types of bonds. We have relationships with all of them. They all look at it differently.
And that's part of it. And that's, I mean, I just will say, like, part of involving us early is we can get a sense of directing you towards the kind of surety that we think is going to be a good partner of yours throughout the project, and not just in providing you bonds, but getting you to, I'd say, a fair price for the risk.
Yeah. Yeah, I was gonna your industry and ours is similar in that in our industry, a lot of borrowers will focus just on interest rate and say, where can I get the best interest rate? But we often guide them to say, well, who's going to be the best fit for you? Who's going to give you the most flexibility? Who's going to be a good partner for the duration of the project? And I think you guys are doing the same thing.
Hold up draws.
Yeah.
It's
a great point. And bonding's a lot different than insurance, where like bonding companies want to create a relationship with someone and support them through the long term. So we've had clients that have started their own integrated GC companies, right, just to build purpose-built for themselves. We want to set them up with the right surety company that wants to be with them for the long term, right? And there are a lot of surety companies out there that want to do that. So it's our job as a broker to find the right partner for that long-term relationship.
Yeah, makes sense. The other thing I'll add here is, like, just as a reminder for borrowers that there is a benefit to you as a borrower for having this bond. So it's not just a flow through and you're protecting the lender. I think you guys call it dual obligee. Is that the right terminology, where you're also providing a benefit for the borrower? Can you speak to how that helps them? Like, it's essentially like if a trade doesn't perform, but does it also give them some sort of leverage where, the fact that there's a bond and there is sort of something hanging over that trade to make sure they know that, hey, if you don't perform, there's a bond here that we can call on. Is that kind of how it works? Or how do you?
It definitely impacts it. I mean, I hate to say, like, it's something that you can leverage or put their feet to the fire, call it, but it is a leverage tool for you as well. But in the event that there is a default, I mean, it's an instrument that you can utilize, and an insurance company is going to come in and figure it out. And these insurance companies have relationships with tons of subcontractors and general contractors throughout all of Canada. And as a result, like they have relationships with groups that they can bring in to make things whole in the event that there was non-performance of a certain sub.
Yeah, and like with residential construction, like you have an interest rate based loan collecting interest, so every month of delay counts a lot, right? So this is super important, especially if you're bonding like a true third-party GC who's doing this under a fixed price contract. If they fail, the amount of time and effort it would take to replace that GC is going to cost you a lot of money. If you have a surety company who provides a bond and can step in and say, hey, maybe this GC company went insolvent, they need $1 million to get up and going again, they can inject $1 million into that company to get this job done, right? The last thing the surety company wants is to pay out a full penal payment on that bond. They don't want to pay out the full bond amount. They rather inject some liquidity into the company, get the project done so it doesn't result in a full claim.
Mm-hmm.
So you have the benefit of that surety company being on your side to get that dealt with.
Yeah, that's well put. That's really, really good. So beyond financing, we'll get into. I know there's quite a few areas that are really important to cover, especially development bonds. I want to touch on, but we have a few questions that came in the chat. If you guys don't mind, if I can just quickly cover them with you. First one is there one of the three alternatives to bonding that we see typically used more often than others? So I could probably answer that, and I would say, it really depends on the situation. We've had some clients say, I have enough equity, I can just reduce the leverage, but we're actually working through something right now where the individual is really, instead of reducing the loan, they actually have a certain amount that they can cash secure, get a letter of credit secured by that cash, and then provide that to the lender, and the interest that they're earning from that cash security offsets the LC fee. I still think bonding is a really strong option, but in the events that it doesn't work, I would say that's good. And then we had another situation where borrower pledged one of their other assets. They had a retail plaza which they pledged as security. It was 50% loan to value, and we just pledged that as security during construction, and then that drops off after construction is done. So it really varies by situation. Second question, do investors, developers typically reach out to you first to evaluate their builder contractor prior to a CMHC submission if bonding will be involved, to make sure there are no headaches after COI approval? I think you guys answered that, right? So probably yeah. Go ahead, actually. Go ahead. I want to answer for you.
Involve us early. I don't think it's probably, Nadeem, you can probably answer this better. Like, how hard is it to change the type of construction contract once you already have a COI? Like, you have to go back to CMHC. Nobody wants to do that.
Mm-hmm.
But you can always pivot, right? Like, if your GC can't get a bond and you have to pivot to get bonds from your subtrades, I'm pretty sure you can do that. You go back to CMHC, which sucks. But you can always pivot if you can't get a bond. But for that reason, get us involved as early as possible. You don't want to do that.
I mean, similarly, I'm working on one now where it's the requirement is for the subtrades or all critical or all major contracts to provide bonds. And we're having issues again with the subs being in a tertiary market. They've never gone up for bonding, and we're having CMHC amend the COI to read the fixed price contract in which we have terms, we're ready to go. So I mean, it's case by case, project by project, but involving us early doesn't hurt in any capacity, at least to walk through kind of your thought process, because we may have seen something, we may have some war stories or something we can, help guide you through.
I'd say November 2024 was when CMHC really changed this, right? And they said, hey, you're gonna need bonding going forward. Most of our files 6 to 12 months after that were, holy crap, I need a bond. What do I do?
What is this bond?
Most of our conversations are now, hey, I know I'm going to need a bond. Here's what I'm thinking in terms of how I'm going to structure my contract, and it's an early discussion. So I'd say we see most of our submissions now before there's even a COI in hand.
Yeah, they're applying for CMHC. I'd say 80% of the time when we're getting engaged.
Yeah. So first-time developer looks like saying, let's say a client has never developed a project in the past. Are you denying clients in today's climate? Or I think they mean are your sureties, are your insurance companies denying them in today's climate? Or is there a significant premium associated with them? Is there a band of high risk? Like we have mezz lenders. Is there the mezz lender equivalent in the insurance world? Or, or maybe the way to put it is do you see some declines from time to time?
Sometimes
we see declines.
Yeah,
yes.
Sometimes. I'd say 85% of stuff we can figure out a way through. There are some tougher files, right?
But it's about going out and then maybe working to find you should find a third party general contractor, right? You may need somebody who actually has the experience to kind of see the project through, and sometimes it takes that kind of pushback, funny enough, from the bonding side, for you to reevaluate. How you're going to push out.
Yeah. So, first time developer who's doing their first project, it probably would help to have a CM on site helping you through construction, right? And if you don't have that and you can't get bonded and you say, hey, I found a GC that's willing to look after this for me under a certain contract, that'll probably get you bondable, right? And we can figure out the guarantee package and the security. And Nadeem, I'm assuming lenders and CMHC also look at that as an important aspect to getting their loans approved.
For sure. 100%. I think like another way to put what you're saying, which I think is a really good point, is if you can get a GC that's bondable, that's probably going to be a really good thing. It means it's a contractor that's financially strong, that's experienced enough, and the third party has vetted them, right? And if your contractor can't get bonding, then maybe that's a bit of a red flag for you as to, especially if you're first time developer, are you using the right contractor? Is that
Yeah.
fair? Like it's got that
Yeah.
benefit too, right?
If you are a first time developer, but you're really well capitalized as a first time developer, we can find bonding for you in that case, more than likely, right? And maybe you only
So,
have to rely on a CM under a construction management agreement. Like,
yeah,
there's ways to figure it out.
yeah, yeah. Sometimes cash can solve a lot of problems.
It's okay.
Yeah, yeah. The question I think we've answered, but is bonding financeable on CMHC MLI Select apps, i.e., borrowing at 95% of the budget, including bonding? And I think like I've spoken to that, but that's a yes. And another reason why that estimate's really helpful. The 1.5%, or maybe go a little up or down depending on the risk profile. But yes, include in your budget, plan for it. Are you using one of the alternatives? Are you going to go bonding? If you're going to go bonding, put it in your budget. Yeah, really. Um, Really good point. I'll see if there's any other questions I noted down here. Um, yeah, one of the questions I wrote down was like the approval rates, which you guys spoke to. I was thinking about how early to approach you. We talked about that. Um, yeah, I think that covers it. If there's anyone has more questions, go ahead. But perhaps we'll transition to the next segment of the webinar here. So over back to you guys. Thank you.
Yeah, so beyond CMHC, we'll start with development bonds. So what are development bonds? So everyone probably knows that you're going to have to provide some sort of security to the region, city that you're developing in. So that could be for your subdivision agreement, your site plan agreement, a hydro and utility connections, and more. So in the past 5-10 years ago, most of these security requirements were provided via a letter of credit, and LCs for the most part are cash secured. So there's been a huge uptick in the acceptance of bonds within many regions and municipalities. And the benefit of bonds versus a letter of credit is that they improve liquidity for developers. So for the most part, a bond is secured by just an indemnity agreement. There's no requirement for cash security like there would be from a letter of credit, and they usually cost about the same. So 1 or 2% is the standard bond rate. And why we think this is super important for developers building rental, especially through CMHC, is a typical construction loan on a condominium, for example, where there's going to be an end product, purchasers are going to take possession of their unit. Usually, lenders will have an LC facility baked into their terms. We don't see that so much when it comes to rental commitment letters from lenders, and often developers have to capitalize a bank account, find a bank to provide an LC. When if they go with the bonding route, they just sign a guarantee and they get a bond. It's super helpful. It frees up a ton of cash. And some recent changes to the Planning Act in Ontario are important to outline. November 2024, Doug Ford made some changes to the Planning Act in Ontario. So if you are developing in Ontario, every single municipality in Ontario now has to accept a bond. Previously to that, there were only some municipalities that would accept bonds, so you had to go the LC route. They're also widely accepted in other parts of Canada, like Calgary, Edmonton, Halifax, Surrey, Kelowna, to name a few. So you're more than likely going to have to provide some security to the city, region, whatever it might be. Reach out to us as it relates to providing a bond. If your municipality doesn't accept a bond, we can work with them to get it accepted. But definitely a great tool.
And I mean, I'll even throw in, Dean, you probably run into this all the time. It's when you're working through this and they have to secure they need the security posted to get to the building permit stage prior to, construction funding, and sometimes months in advance of. And that's when we're seeing this tool extremely valuable as well. It's even just it's timing. The timing aspect is so much value.
100%. I think that's a really good point, Brendan. Which and I've seen it where we get approval, we get CMHC-CY, we get a commitment letter, and all the equity is injected. And often developers have put all the equity in, and they need to spend millions of dollars to be able to get the building permit released. and by posting some of the security. So if they can get a bond, often that helps because otherwise they're scrambling to get cash for a short period of time before the first loan draw. Because sometimes the first loan draw can repatriate a bunch of cash, and to get to that point, developers are often having to spend a bunch of soft costs, municipal costs, development costs, architect costs, and they're not as liquid right before that first draw. So I think that's a really, really good point. Um, uh,
And
yeah,
yeah,
go ahead.
I'd also add one quick thing, like oftentimes there are some early securities that are required, like just far in advance of the construction loan ever funding. Um, Having a bonding company underwrite these development bonds is also a good segue into the actual CMHC performance and L&M bonding, because sometimes they say, hey, we really like this developer, we like this project, we want to do this development bond for them. Please let us look at the CMHC performance and L&M bonding for it too, and we create that relationship early days, so it makes it easy when you need the bonds for CMHC performance and L&M, which are different than these. It makes it easy because we can find a partner early days.
Yeah, it's a really good point. Like I'll just even like back up a bit for those that are maybe newer to this concept, maybe some of the first time developers on the call. Like essentially the municipalities are looking to have some security that if a project doesn't complete, whether it's the site work or the landscaping or some of the connections that need to be done, they have a torn up site if a project goes bust. And so they want to have some security that in the event that something happens, the municipality can call on some capital to repair or fix or bring back a project to where it was before it started. And really, like the three alternatives you have is one, you can post up cash with the municipality and they'll happily hold your cash during the period of construction. Number two, a lender can provide you with a letter of credit, and that's essentially something that can be drawn upon. Either the lender providing the construction financing can provide it, or you have another lender that provides it, and maybe they have some other cash security, some other real estate security. One of the things I've found is if we're cranking the leverage on a CMHC construction loan, there's some lenders that can provide letters of credit in addition to the CMHC construction loan, but the leverage can't be cranked all the way to the max generally. And there's many other lenders that aren't able to provide letters of credit as well. So there's a lot of solutions here. Not everybody knows about these, and I think it's really great. And I think more and more people should really consider this as one of the important alternatives. So just to set the stage, at least from the financing standpoint. Yeah, go ahead.
That was awesome, Nadeem. I think we go to the next one.
Yeah, next slide. Construction lien bonds, another foundational kind of product that we offer or to our developer solutions group. Disputes happen between subs, between general contractors, and a lot of the time when those disputes, no agreement is made, a sub or general contractor will lien a project, and they place a lien on title, and it takes priority over any other lien that's on title, which means basically your construction lender can't fund anymore. There's really only two solutions to discharge a lien and to keep funds flowing into a project, and that's either post cash to the court or you post a lien bond. The lien bond is underwritten on what has happened, what is the dispute, and underwrite the financials and underwrite where the project is. Please engage us, and I can send you a full list. But the idea is these bonds are issued similarly to the development bonds on a guarantee only basis. So instead of posting cash in the courts, that's also marked up to the lesser of 25% or $250,000, stuck there in the courts until the dispute is mitigated or finalized. You can post this bond and keep funds flowing into the project, keep your cash on hand and on your balance sheet.
Yeah, and so these bonds, like the lien bonds, they're usually guaranteed by the same guarantee group as the construction loan.
Mm-hmm.
So to Brendan's point, like we'll want to understand why is there a dispute, right? If you're at fault for the dispute, a surety company might not want to provide a lien bond. But if a contractor went insolvent, or they didn't complete the work, or they're trying to overcharge you, and there's a big dispute, and they just throw a lien on title, and it's not your fault, and you've paid them, we'll underwrite that, and we can more than likely get a lien bond issued for you and clear title.
Yeah. Just to throw in that, they're not always easy, but super valuable. And then the other piece is pricing is typically a little bit higher because you have to keep in mind a surety is jumping in the middle of a dispute where a lot of the time they don't have a relationship with either party. So at the same time, normally they are charging a markup. I'd say 2 to 3%. Sometimes you see sub that, but yeah, they're a very, very valuable tool when you're getting into a dispute and you're trying to get a draw.
Do you sometimes see like the same company that provides bonding for the CMHC requirement, labor materials performance, being the company that does this as well?
For sure. And it was super prevalent in like the condo space, right? Because of deposit insurance, where the surety company would have deposit insurance or be a lender too, and it's in their best interest to clear title, right? Because they're also a creditor in it. Same thing with rental, where they have a performance and L&M bond out. They don't want the same to fail. And if there is a true dispute, like more than likely, to your point, the same surety that issued the performance and L&M bonds might step up and issue the lien bonds. If not, we have other markets that can do this stuff. So it doesn't always have to be the same provider.
Yeah, I think this is like really great as well, again, because this can be a showstopper to any advance. Like if there's a lien shows up in title, construction advances can get delayed. And sometimes I've seen, developers get put in a tough spot because of a good faith dispute or the subtrades being unfair. And so sometimes they'll either be rushed to settle a claim and pay more than they should, or post the whole amount into a lawyer's trust account. But here, they're only posting 25%, paying a small fee, and keeping more of their cash. So I think it's a really good option. Are these pretty quick? Can these be relatively quick?
I mean, when they come in, we generally move quick because it's normally right up against when a draw is supposed to go through. So Frankie and I jump when these do come in, but I'd say it's about 2 weeks probably start to finish.
Got it. Thank you.
I'm going to touch on these high level, more just to comment on what we do as an insurance brokerage as well. But I'd say the bulk of platforms employees do work more on the insurance side of construction. And when you're building a residential project, not only would I say that these are best practices to have, but your lender will likely require both of these. So your builder's risk is your first party risk, so that covers all physical damage to a project. Your wrap up liability is any third party liability that happens on site. Really, I just wanted to showcase that because Frankie and I are getting involved so early on the bonding, what we'll normally do is go out to our team as well and provide you a second set of options. Keep everybody honest in the marketplace. I'm sure you have a broker relationship, but it never hurts to see another proposal.
It's a great point. Like when we're working on the bonding, it's usually before you actually need this type of insurance, and like we'll just quote it for you anyway if you want, right? And maybe it's cheaper than your current broker or insurance provider. Maybe our quote helps you leverage a cheaper price with your broker, or you just go with us. It's easy for us to quote. We usually like to attach to our bonding.
And just I guess the last thing I'll throw on this is we also, and to highlight our construction practice group, is they've also recently created a proprietary builder's risk facility, which we've seen as being extremely sharp rates. We wrote the policy wording. It's a full comprehensive policy. So we do like to try to at least present this as well when we're looking at the policy. So I just wanted to highlight that.
And what that means is like your current broker isn't like, we're not going to block their markets. It's our market only, the platform. So we're not going to mess with that relationship if we end up quoting.
Yeah, it actually, like, it's perfect segue because that question just popped in that said, what market would you go to for bonds? I'm not sure exactly what that means, but maybe you guys do.
There's a lot of them.
Yeah.
Some of the big alpha house names like Aviva, Travelers, Intact, Trisura. There's a bunch of other smaller ones. Some that we have exclusive relationships with. We might not disclose on the call, but there are a lot of options out there.
Yeah, amazing.
And then again, similar to this is if we're looking at the construction, again, using one brokerage just makes typically a developer's life easier. We have a team that focuses exclusively on insuring income producing assets and large property schedules. Again, it's not Frankie and my specialty, but I did want to highlight that our firm can do everything from acquisition to stabilization and owning long term. So something that we can also help groups with.
Amazing. Okay, I got that's the end of our formal presentation. I know we're actually right on the hour, so we did great. I'll see if there's any more questions that popped in since the last one. I think there's one more. Okay, I think this was just a few people saying thank you for the presentation. Sounds like it's helpful. I think that's it. No other questions. Do you guys have any final parting words of wisdom?
You got our contact information. Like, use this as a resource for absolutely anything. If you want to run something by us, just reach out. We're happy to help.
Yeah, use it as a sounding board.
Yeah.
Really, even just to run through ideas. And then I also like highlight, we work with guys or groups like yourself, Nadeem, obviously, and it's using everybody collaboratively. I think is the best approach when this comes up, and just getting us or your broker involved as early as you can, because these bonds can impact the scheduling of your project. So.
Yeah, a couple of quick things. Someone's asking if we get a recording. The answer is yes. We'll have a full recording. We'll put it up live and share it on social media as well as via email. Someone's asking how much would it cover in the event of a cost overrun? Do you guys have a sense? Yeah, go ahead.
It would be like in terms of a cost overrun for the entire project. It's definitely a question to talk about outside of this call, because every contract and every bond wording might be different. But oftentimes there are products and bonds that might cover that, but it depends on how the contract's structured.
Mm-hmm.
Yeah, fair enough. Case specific, reach out. I think that, yeah, oh, here we go. Okay, so someone asked the same question. In the event of a not significant cost overrun, say 10%, would bonding cover that? I mean, I think it's the same question really, but maybe you guys, I'd suggest people reach out to you directly perhaps to touch on that. Okay,
That's
fantastic.
Yeah.
Amazing. Okay, I think we're there, and we're at the hour, so I want to be mindful and respectful of everyone's time. But I think this was a phenomenal session, really value adding. Really appreciate your time, and thanks for everyone that joined as well.
Yeah, thank you everyone for having us, and thanks Nadeem for setting this up and having us.
Yeah, absolute pleasure. Thank you.
Fantastic. Thanks again, guys. Take care.
Take care. Bye.